If you spent the last 20 or 30 years maxing out your 401k or traditional IRA, doing exactly what every financial book told you to do, I want you to sit with a strange question for a second. Is it possible you saved too well in the wrong place? If you're within 10 years of retirement and most of your savings are in pre-tax accounts, this video could change how much of that money you actually get to keep. Here's exactly what's happening, and more importantly, here's exactly what to do about it. My name is Andrew Matz. I'm a financial planner at Oak Road Wealth Management, and we work with pre-retirees and retirees who have done a great job of saving, usually between $1 and $2 million in retirement savings, and we help them turn that nest egg into a confident, sustainable retirement plan. And one of the most common conversations isn't, did you save enough? It's, you save really well, but almost all of it is pre-tax. And let's talk about what that actually means when you spend it. Now, before you panic, this is not a video telling you that you made a mistake. Stick with me to the end because I'm going to show you a strategy that lets you redirect a chunk of this tax bill towards something that you actually care about instead of just handing it over. But first, let's understand exactly what's going on, because most people don't realize how this actually works until it's already happening to them. So here's the deal. When you put money into a traditional 401k or IRA, you get a deduction today. So if you put in $10,000 this year, that 10 grand comes off your taxable income right now. So that's the appeal. That's why everyone tells you to do it. But that money was never actually yours tax-free. The IRS doesn't forget about it. They agreed to wait. So fast forward to retirement. When you pull the money out, whether the contribution or the growth on all of it that earned over the past 20 or 30 years, every single dollar is taxed as ordinary income, not as capital gains. It's ordinary income, just like your paycheck. And that surprises people. They think, I already paid tax on some of this. No, you actually didn't. The contribution was pre-tax, the growth was tax-deferred, not tax-free. So $1 million traditional IRA is not the same as $1 million Roth IRA. One of those $1 million has an IOU to the IRS attached to it, and the other doesn't. This becomes a real problem when you have a large pre-tax balance. And I'm talking to the person watching this video who has 7 figures sitting in a 401k or rollover IRA, because eventually the IRS doesn't just wait for you to decide when to take the money out. This is where required minimum distributions come in, or RMDs. Once you hit a certain age, currently 73 for most people, the government requires you to start withdrawing a minimum amount from your pre-tax accounts every single year, whether you need the income or not. This amount is calculated using your account balance and a life expectancy factor from an IRS table. And here's the part that catches people off guard. The bigger your balance grows, the bigger that required withdrawal gets. If you've done well investing, and many of the people I work with have, your RMD can end up being a lot bigger than you expected purely because the market did its job. So let's say it's a normal year, you're not taking a big withdrawal because you don't need one. Maybe you've got a pension, maybe Social Security covers your baseline expenses. It doesn't matter. The IRS says you have to take it anyways. And when that money comes out, it's added on top of what other income you already have. So that means it's taxed as ordinary income. It happens automatically every year, whether you want it or not. It only gets bigger as you get older, at least for a while. And this is where the real squeeze starts. If your RMD is large enough, it can actually push you into a higher marginal tax bracket than you were in while you're still working. That's possible. I've seen this happen to people who paid a very reasonable tax rate during their career, and suddenly in their mid-70s, their RMD alone puts a meaningful chunk of their income into a higher bracket. And that's the opposite of what people think is going to happen in retirement. But it doesn't stop at income tax. There's a second, quieter cost that catches even more people off guard. It's called IRMAA. It stands for Income-Related Monthly Adjustment Amount, and it's a surcharge on your Medicare Part B and Part D premiums if your income crosses certain thresholds. So here's what makes IRMAA really frustrating. It's based on a 2-year look back. So a large RMD or Roth conversion or big capital gain could raise your Medicare premiums 2 years from now. People get a letter from Social Security saying their premium is going up. They have no idea why, because they've forgotten about the RMD that they took 2 years earlier or other big spike in income. So you can end up in a situation where a big pre-tax balance doesn't just mean a bigger tax bill, it means a bigger tax bill and higher Medicare cost layered on top of each other, often in the exact years when you're trying to enjoy retirement the most. I want to be clear about something though. I'm not telling you this to scare you. I'm telling you this because almost none of our clients knew this was coming until we ran the numbers together. And once you know it's coming, you have options. So here's the best part. I promised you at the beginning, if you're charitably minded, meaning you already give to a church, a favorite nonprofit, or a cause that you just really care about, there's a tool that lets you use some or all of your RMD to satisfy that generosity instead of just paying tax on it. It's called a Qualified Charitable Distribution, or QCD. Once you're 70 and a half or older, you can direct money straight from your IRA to a qualified charity. And when you do that, that amount counts towards satisfying your RMD for the year, but it does not show up as taxable income to you. So let me say that one more time, because it's the whole point. Money that would have been fully taxable as ordinary income instead goes directly to a cause you care about, and it never touches your tax return as income. If you were already planning to write a check to your church or charity this year, doing it through a QCD instead can be one of the most efficient moves available to someone with a large pre-tax balance. There's a current annual limit on how much you can give this way. The number does get adjusted periodically for inflation, so I'd rather you and I look at the exact figure that applies to you rather than me throw out a number that might already be outdated by the time you actually watch this video. But directionally, for a lot of people, a QCD can offset a meaningful chunk, or a lot of times all, of their RMD. And QCDs are just one lever. Depending on your situation, there are other strategies, things like doing partial Roth conversions in lower income years before RMDs start, or spacing out withdrawals strategically in your early retirement years that can often soften this over time. The point isn't that you're stuck. The point is that this deserves a real plan, not a guess. Now here's what I really want you to take away from this video, because I don't want you leaving here feeling like you did something wrong. That's not true at all. If you're watching this and you've got a large pre-tax balance, I want to say this plainly. That is a great problem to have. It means you saved, you were disciplined for 20 or 30 years, when it would have been much easier to just spend that money. Taxes, they're a real cost, and they're worth planning around carefully. But they are a secondary issue compared to the question that actually determines whether your retirement works. And that question is very simple. Can you meet your goals confidently for the rest of your life? $1 million in a traditional IRA and $1 million in a Roth IRA are not identical. I want to be honest with you about that. But they're both fundamentally $1 million of choices, security, and options that most people never get to have. Whether your balance is pre-tax, Roth, a mix of both, having built that balance at all is something worth feeling good about. Tax planning is about keeping more of what you've built. It is not, and never should become, the whole point of the plan. I say this because sometimes I hear people and they get so focused on minimizing every dollar of tax that they lose sight of the actual goal, which is having a retirement that lets them travel, help their kids, be generous, and not lie awake worrying about running out of money. Don't let tax optimization become a source of stress. Let it be one input into a bigger plan. And this is exactly the kind of thing that we walk through with our clients at Oak Road Wealth Management. Because at the end of the day, the goal was never to pay zero taxes. The goal is to know with confidence that the plan works for you, for the years ahead, for the people and causes that you care about. And if this resonates with you, click the link in the description below to schedule an introductory call with our team. It's a quick, no-pressure conversation to see if we're a good fit to help. And if this video was helpful to you, the most useful next step for you is to leave a comment letting me know where you're at with this. Are you already taking RMDs? Is this still years away for you? I read and pin the top comment on every video, so you usually find more resources for exactly this topic waiting for you there. But otherwise, thanks for watching. I'll see you in the next video, and please like and subscribe.